Up or down, it is high time that Bitcoin made a significant move, market participants agree. Bitcoin, BTC, starts a new week keeping everyone guessing as a tiny trading range stays in play. A non-volatile weekend continues a familiar status quo for BTC USD, which remains just above $19,000. Despite calls for a rally and a run to lower macro lows next, the pair has yet to make a decision on a trajectory or even signal that a breakout or breakdown is imminent. After a brief spell of excitement seen on the back of last week's United States economic data, Bitcoin is thus back at square one literally, as price action is now exactly where it was at the same time last week. As the market wonders what it might take to crack the range, Cointelegraph takes a look at potential catalysts in store this week. For Bitcoin traders, it is a case of almost too quiet when it comes to the BTC USD weekly chart. Having come down significantly in volatile conditions over the first half of 2022, recent months have seen an almost eerie lack of volatility. Data from Cointelegraph Markets Pro and TradingView proves the point on one-week timeframes. Bitcoin continues to print candles with almost nobody whatsoever. Such is the stickiness of the current range that, as Cointelegraph reported, the Bitcoin Historical Volatility Index, BVOL, is at lows only seen a handful of times. Equity volatility, VIX, relative to Bitcoin volatility, BVOL, is approaching all-time highs. William Clementi, co-founder of digital asset research and trading firm Reflexivity Research, added in comments last week, this illustrates just how much volatility compression Bitcoin is currently experiencing. An accompanying chart neatly captured Bitcoin as a curiously stablecoin-esque pick in the current climate, with Clementi implying that a return to the classic, more volatile paradigm should follow. The week prior, economist, trader and entrepreneur Alex Kruger additionally noted that an explosive move had followed all prior trips to macro lows on BVOL. He argued that United States macro data missing expectations would do it in terms of rekindling volatility, but in the event, the numbers remained just short of the trigger range. Cryptocurrency research firm Delphi Digital agreed. Historically speaking, when the BVOL falls below a value of 25, a large spike in volatility tends to follow shortly thereafter, it stated in part of Twitter comments. This week, meanwhile, popular crypto investor and analyst Miles Deutscher told traders to get ready while commenting on the Delphi data. The question for everyone remained the direction that volatility would take the market in. For Illinois Capo of crypto, the trader who predicted Bitcoin's descent to $20,000 levels from all-time highs, expectations remained the same. $21,000 should feature as part of a relief bounce, only to be eclipsed by a fresh dive to multi-year lows for BTC USD, these potentially coming in at $14,000 to $16,000. Some shitcoins will experience scam pumps during these days, while $BTC goes to $21K. This could give you the illusion that the bull market is back, he warned over the weekend. My advice, don't be greedy. Take profits if this happens. Protect your capital. While little is expected from the Federal Reserve in terms of direct policy changes this week, there is still plenty of firewood for crypto volatility set to be provided by external forces. In the United States, company earnings will be coming in thick and fast, with tech stocks particularly apt to move markets in the event of results falling wide of expectations. Reporting firms represent over 20% of the S&P 500, which like other US indexes is showing rare weakness this year. In my mind, the odds of a low coming in the next week or two are decently high. Raoul Pal, founder and CEO of Real Vision, predicted overnight alongside an accompanying chart. The SPX weekly demark hits next week, near the bottom of the channel and the 50% retracement, with record bearish sentiment. Charting the week ahead, financial commentary resource The Kobayashi Letter likewise told subscribers to prepare for more volatility. More US data will join earnings this week, it explained, while Fed officials will comment on overall policy. The median bear market with a recession dating back to 1929 has fallen 39%. It wrote about stock market strength in one of the various posts over the weekend. Furthermore, the median bear market with a recession lasts 16 months. We are currently only 10 months in and the S&P 500 is down just 28%. History continues to suggest that more pain is ahead of us. Beyond stocks, the US dollar index, DXY, was mercifully motionless into the new week, so far avoiding another attack on 20-year highs seen earlier. Echoing Illinois capo of crypto's theory, Michael Van der Poppy, founder and CEO of trading firm 8, hinted that it could be this week or next that some relief enters for risk assets more broadly. A crucial area for Bitcoin, as it's still hovering in the range for more than a month, he summarized on the day, it needs to break $19.4-19.6K clearly. If that happens, volatility can finally kick in. Given the structure of the $DXY and the yields, I expect this to occur in 1 to 2 weeks. Further out, the picture for Bitcoin becomes murkier, and those divining bearish scenarios from current chart data are busy channeling comparisons to the 2018 bear market bottom. Among them is popular analyst Matthew Hyland, who even in his characteristic bullish market takes has little to celebrate when it comes to the next few months' BTC price action. In a tweet from this weekend, Hyland flagged Bitcoin's relative strength index, RSI, repeating behavior seen in the build-up to the 2018 floor. An accompanying chart clearly demonstrated familiar bear market forces in play, adding to suspicions that Q for 2022 could closely mirror the scenes from 4 years ago. Trading account Stock Money Lizards confirmed that it 100% agreed with the idea, which uses the 3-day chart. The 2018 RSI breakout structure involved a dive from $5,500 to $3,100 for BTC USD, or roughly 40%. Obviously, we're still waiting for this huge move to come, Hyland added in a related video about the idea. He additionally showed that the classic Bollinger Bands volatility indicator was still predicting an incoming storm, with narrowing bands demanding a breakout of volatility. Taking a look at hodler behavior, and it becomes apparent that the resolve of the average long-term holder, LTH, remains steadfast. The latest data from on-chain analytics firm Glassnode confirms a 5-year high in the number of Bitcoin either lost or out of circulation in cold storage. The hodled or lost coins metric put the tally at 7,554,982.124 BTC, or 40% of the current supply as of October 17, meaning that more BTC is off the market than at any time since late 2017. Likewise, distribution is also continuing an accelerating trend visible throughout 2022. The number of wallets with a balance of at least one whole Bitcoin is now at an all-time high of over 908,000. While increasing overall through the latter half of 2021, the trend has gained noticeable momentum this year, Glassnode shows. Analyzing lost coins as part of its weekly newsletter, The Week on Chain, Glassnode, meanwhile, concluded that the current bear market has yet to match others in terms of intensity when it comes to hodlers. Network profitability has not quite hit the same level of severe financial pain as past cycles, however adjustment for lost and long HOD-led coins can explain a reasonable portion of this divergence, it explained last week. Nonetheless, when it comes to those used to hodling through bear markets, it appears that there's little appetite for capitulation from current price levels. There seems to be no shaking the fear when it comes to crypto market sentiment. In a sign which has captured the industry this year, the Crypto Fear and Greed Index has now had sentiment in its fear or extreme fear for 2 months straight. Fear and greed uses a basket of factors to compute a normalized score for market sentiment, and 2022 has delivered results unlike most years. Earlier, the index saw its longest ever stint in extreme fear, a feat which is currently 1 month away from repeating. As of October 17, the index measured 2100 around 10 points higher than classic bear market bottoms but a full 14 points higher than this year's low. The views and opinions expressed here are solely those of the author and do not necessarily reflect the views of Cointelegraph.com. Every investment and trading move involves risk. You should conduct your own research when making a decision.